Welcome, everyone. I'm Caroline Woods. Today, we're discussing the path to financial wellness in any economic climate, but specifically the one we're in now. Joining us today is Waddell, Executive Vice President of Empower's Retirement Solutions Group, as well as Steve Jenks, Chief Marketing Officer of Empower. Thanks to you both, Carol and Steve, for joining us. Look forward to our conversation.
Thank you.
Thank you.
So before we dive into the questions, I just want to remind everyone that's on that we, of course, want to hear from all of you. So please type any of your questions into the chat. We'll get to as many as we can. Also, please feel free to take our poll, and we'll talk about some of those results as they come in. But all right, let's get right to it. Steve, let's start with you. I know you've recently conducted a wealth and wellness survey. So curious to hear about some of the results. How are Americans feeling right now?
Well, it's been quite a few years between the COVID pandemic and what we're seeing now with inflation and the overall economy, and we're seeing that very much reflected in our research. Interestingly, we had originally done this study last year, probably not too far off this time, and one of my vivid memories from that is what we saw with consumer sentiment was a little different than what we were actually seeing at the stock market at that point, because we were still seeing market records. But our most recent round of this survey is what we found is that, first of all, people are very worried about inflation. 85% of folks are worried about rising inflation. And then 74% of folks are worried about we are either in or there's a recession approaching. So certainly, if any of the folks on this session are worried about these things, you're definitely not alone.
Certainly not. And Carol, how do those survey results compare to what your advisors are hearing when they talk to clients?
Yeah, great question, Caroline. We're certainly having lots of questions around inflation and a likely recession. Our customers are seeing their returns and their balances decline, and the advisors are feeling lots of questions about what they should do. And typically we're giving a couple of key pointers. One, first and foremost, just stay the course with your strategy. Don't make rash decisions and lock in the loss. The underlying value of the securities in your portfolio may be at a lower price, and it's not guaranteed, but historically the markets have recovered. So if you hold on to those securities, you might benefit from a market rebound as the prices increase and your portfolio value rises as well. But if you sell the investments right now, you're going to pass up on that potential rebound and truly lock in the loss is what we refer to it. Often we'll draw an analogy to your home. People buy their home at a certain price, it goes up and down. If you sell at a low price, you've forgone any possible, appreciation in the value of that asset. So, the advice is don't do anything rash. We've weathered these types of storms before. When advisors actually look at providing you with an asset allocation strategy, they typically use something called Monte Carlo simulation engines, which runs thousands of different scenarios that look at all different types of market events. And then they put that strategy in place with that in mind. So stick with the strategy and revisit your asset allocation in consideration of things that may have changed in your life or your goals have changed and things like that. You could work with an advisor and go through that as well. But sticking with the plan is our basic advice right now.
And in terms of mitigating risk, not running away from it altogether, basically.
Exactly.
So, Steve, you talked about how people are feeling, but there's this whole concept of financial wellness. So how financially fit are most people at this point? Especially, we've come a long ways since the pandemic, but it just changed so many of our lives. And what would make people feel more fit? What are you hearing?
Yeah, we've seen a big change in people feeling financially fit or financially well. And, it's an interesting term, right? Because I think everybody has a different definition for it. What might be financially fit for me may be different from Carol, may be different from Caroline. But we've definitely seen a decline. I think when we surveyed this at the beginning of 2021, it was about 22% of folks, 38% of folks, and we've seen that drop down to 22% of folks when we did this last survey. So clearly everything is happening out there is having an impact on how people think about being financially fit or financially well. And I think a lot of what we would advise or see is you've got to control what you can control. Obviously, none of us can control inflation. None of us can control the overall economy and what's happening. But for example, we can control our budgets and we can control what we're spending. So I think in these types of times, particularly when there's unknowns, you focus on what you can control and what you can do. The other trend we've seen is, during times like this where it's very difficult to make up your mind or choose directions, we are seeing that a lot of people wish they had asked for financial advice earlier. One of the questions we posed recently is, do you feel you got financial advice in time for those who are using it? And I think 54% of folks told us they wish they had taken that step earlier. So that's another thing that you can do that's really within your control during times like these.
Well, speaking of controlling what you can control, I was just taking a look at some of the poll results. Please still feel free to answer the poll question. But of course, the question is, what actions are you taking in response to the slowing U.S. economy? Of course, inflation is a big part of that. So far, about 35% of people who have responded say they are cutting back on discretionary spending. So one way to control what they can control. Unfortunately, with inflation, though, even if you buy less, you still might be spending more because prices are so high. So let's kind of break down the key issues, starting with inflation. Carol, what can people do to minimize the impact of inflation when it comes to their personal finances?
Yeah, I'm excited to see the results of this survey. Cutting back on discretionary spending is a critical step in the right direction. I would say that inflation has certainly been challenging for many. It's when your purchasing power is actually getting weaker. Our research shows that 86% of Americans have taken some type of action to try and minimize the impact on their wallets. But first and foremost, it's really important to get your arms around what your whole financial picture looks like to be able to evaluate your financial health. You can't make improvements if you don't know where you stand today. And then the next step is really just to create and maintain a budget. To the point we made here, are there any discretionary expenses that you can cut back on? Many people cut spending on things like eating out, entertainment, traveling. Can we push that family trip out, one more year? And we've seen recently people even calling us and working with financial planners to prioritize some of those mid-sized purchases like a car or even a second home if they're fortunate enough. Think about putting that off a little bit longer too. You really, in the midst of periods of inflation, you don't want to spend any more than you need to. Remember, your purchasing power has declined. So the best way to go about this is really to create that budget, figure out what's discretionary. If you don't have a tool to do so, check out personalcapital.com. There's a free and very easy to use tool there where you can aggregate all your accounts and establish that budget. So yes. Glad to see our audience is taking the right steps already.
I will say I've used that for years, and it's sometimes surprising when you actually see all of your purchases in front of you. You're like, that must not have been me. Sure enough, it was. But inflation and recession risk, at least, certainly go hand in hand, Steve. So what sort of actions are people taking to prepare for what could be a potential recession?
Yeah, and that's a great question. One of the things we were interested about, or I was interested to see in this last round of research, is kind of what consumer sentiment is around the possibility of recession, because you still see it debated to a degree out in the media. But it was interesting to us that 73% of Americans said they were preparing for a recession in some way. So clearly from a consumer sentiment perspective, it's expected. And I think the results of I'm kind of reading some of the chats and the polls as we talk here, and it's similar to what I'm hearing from our audience. But we found that 38% of people were looking at delaying major purchases. Very consistent with what Carol had talked about. That 32% of folks were looking at other ways to generate income or revenue. So do a side hustle or find an additional opportunity. And then 31% of folks were setting aside more money in a short-term savings or emergency fund, or in the contrast, depending on their situation, maybe paying off debt a little more aggressively. So what I found interesting in all this is, it does show, and the data does show that Americans kind of understand it's important to take steps to get ready for a potential recession. But at the same time, I think it is important to think about, you may want to curb spending or make adjustments in the short term, but separate kind of what you're thinking about doing in the short term from kind of maintaining those longer term strategies that you might have around saving for retirement and things like that. Because having been doing this for a lot of times, I've seen recessions, markets go up and markets go down, and recessions come and go. So you want to be consistent in your longer term strategies.
And Steve, Wesley asked if we could repeat the personal financial website again as CMO. It might be a good opportunity for you to offer that website again.
Well, I appreciate being asked. Yes, no, it's personalcapital.com. And it has a whole set of free tools that you can use to evaluate your overall financial situation and a bunch of different scenarios that you can model as well around things like retirement savings and overall changing spending habits and things like that.
And it looks like Mary responded to Wesley as well, making it even easier. So Mary, thank you for that. So Carol, sticking kind of with the idea of preparing for a recession, what sort of steps can people take to mitigate risk when they're specifically thinking maybe about their portfolios?
Yeah, I could see there's some comments out there around equity exposure or concentration in individual securities. Diversifying your portfolio is job one. So make sure you're investing in a mix of stocks and bonds. That will be critical. The basic principle is that you want to wind down your equity exposure as either you age or you get closer to needing to access that money. And as you get older and closer to needing those savings, you don't have as much time to weather the storm or weather a dip in the market and wait for that bounce back. With regard to asset allocation in general, I'll share a common rule of thumb, and it is take 100 and minus your age. So if you're 55 years old, you might want to have 45% of your portfolio invested in equities. But it really varies on so many factors like your risk tolerance, your other assets, your debts, how much money you're going to need each month, when you anticipate retiring. Many of those things factor into it. So take all those considerations into effect when thinking about your allocation. But 100 minus your age is kind of a common rule of thumb. And then consider meeting with a financial professional to determine whether it's time to rebalance your portfolio in light of any kind of changing circumstances. We do find that advisors can help you manage not only short-term and long-term goals in your overall asset allocation, but they can help you with day-to-day financial decisions too, and figure out how to invest that money. The longer your time horizon, the more time you're going to have to weather markets like this one. However, of course, if you have some short-term goals, you might want to think about putting some of that money in a more conservative vehicle for savings, like a high yield savings account, money market funds, CDs. Those are all becoming very, very popular now for people with shorter term needs. But the most important thing is stay focused and remember that markets typically have recovered from recessions. And I was looking at some stats before this. The average bear market lasts a little over a year and has a high value to low decline of roughly 35%. This one's lasted almost a year, and the declines are, getting a little bit greater than 20%. So it may not be over, and it's tough to predict, but sticking with your strategy is the best course of action.
And Carol, just building on that, I'm seeing a few questions here. Jim talked about some fixed income opportunities. It seems like Jim, maybe Carol addressed that with her idea about diversifying your portfolios, a mix of stock, bonds, cash. I do see from Axel talking about speaking specifically about index funds, specifically collecting dividends, and that kind of plays into Paul's. Any suggestions for generating passive income? I know dividends can be an income opportunity, but just broadly speaking, Carol, any specific comments you have about generating passive income to offset Social Security in this current environment?
Yeah, I would say that's really very individual, and it's, you'd get the most value out of working with an advisor and walking through your specific scenario. I'm a little hesitant to comment on any individual situation.
Okay. All right. So Steve, sticking with this, the whole inflation idea, I guess good news, bad news is that we've been here before, right? So what have we learned from previous recessions that we can use to navigate the next one?
Yeah, no, it's very interesting. We went back and did some research, and we really looked at recessions going back to the late 1800s to try and get a feel for what happens very specifically with the market. And I think, again, this is general, and none of us can predict the future, and certainly I cannot. But I would say the general pattern you often see is the market is anticipating what's going to happen, not necessarily what's happening right now. And so often you will see, we saw scenarios where, the market had priced in, is pricing in a recession maybe before the recession was officially declared. And really the same thing on the recovery side. Sometimes the market will price in the recovery or the end of the recession before the event actually takes place. So I think one of the things we'd encourage folks to think about, and certainly based on the research, is this kind of concept that the market is anticipating what it thinks is going to happen. And again, we'll just tie back to if you think about the capital markets in that way, where the market's trying to guess where everything's going to go, and that's how things are priced. It kind of emphasizes again the importance of having a long-term plan and being very consistent in this plan, because there's the age-old stats that you can benefit a lot from missing some of the worst days in the market, but you get hurt even more from missing the best days in the market. So that's where a long-term investing strategy can be really important, particularly for goals like retirement.
Speaking of retirement, Carol, what about people who are retirement age or who are already retired? I know you talked about that 100 minus the age, and that could be their equity exposure, but how should they be thinking about their strategy when it comes to navigating uncertainty and volatility if maybe they don't have as long of a time horizon?
Yeah. There are a couple considerations, for those in retirement or getting close to retirement. I would say first and foremost, can you live on a little less this year than you had anticipated? If you can decrease your spending, you're going to have more of your assets in the market when it rebounds. So one, can you live on a little less? We talked about earlier deferring purchases, and it sounded like a lot of our viewers today were doing that. Your dollar is worth less now. So if you can delay those purchases, this can have a very, very positive impact on your future assets. And then lastly, sometimes people enjoy doing this, sometimes they don't. You might contemplate going back to work even part-time to supplement your income. So keep, again, those assets in the market, keep them working for you and participating in that rebound, and see if you can offset that income with new income through employment.
Yeah, I was just taking a look at the poll results. In addition, it seems like the majority is still cutting back on discretionary spending, Steve, but the next 32% are rebalancing their investment portfolios, and then 20% are building their cash cushion or their emergency fund, which we know is so important. But any other final thoughts from you, Steve, on the best ways to go about managing people's money during this economic environment?
Well, I was going to read a little bit of the poll at the same time, Carolyn, and I'm encouraged by the results. I mean, it's exactly the types of steps that we were talking about. The only other point I'd make is that I think we're finding that individuals are very resilient in this type of particularly around their long-term plans in this type of atmosphere. I mean, Empower works with over 17 million individuals for workplace retirement plans. And one of the things we've looked at is, are people changing their retirement savings level in this climate? And actually what we're seeing at this point is we've almost twice as many people who have increased their retirement savings versus decreased it, despite the fact that many folks are facing some short-term financial hardships. And so I think that underlines for us really the kind of the power of sticking to, while you may want to make short-term adjustments, and that can be entirely appropriate in these types of situations, stick to that long-term plan, because it can really pay off for you. And time is the most powerful thing in terms of investing.
And Carol, we have just about a minute left. So in terms of if people are interested in speaking to a financial advisor, what should they do to prepare for that? Or should they expect from those conversations, just in terms of navigating their way through it?
Yeah, the best way to have a very productive conversation with either a registered investment advisor or a certified financial planner is to get as much of your financial data together in advance of that call. So, pull together all of your assets, pull together your debts, pull together maybe any kind of insurance you have, and think through in preparation what some of your goals are, both short term and long term, whether it's a car or a home or college or retirement. Get all those things lined up and then bring that to the table when you're working with your advisor. And what you can expect them to do is take all that data and information, put it together, and create a holistic picture so you can see, one, how much discretionary income is available, and then two, start to talk about some trade-offs in your goals. And sometimes, common ones we've seen recently, we had a gentleman call recently that was going to purchase a new car, and he went through an analysis with one of our planners and found, wow, if you funnel that money back into your 401k plan, participate in more match, you can actually retire a little earlier. So you can expect to have a very fruitful conversation around making some important trade-offs like that.
All right. We really appreciate the advice that you've given, laid the groundwork to make some good fiscally responsible decisions. Unfortunately, that's all the time we have. So many thanks to Carol and Steve and to Empower. Thanks everyone for participating.